Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment and obsessed with land and royalties and gold and oil and all the good old-fashioned stuff. We're back, boys, and the one girl that might be watching this, the revenge of the old economy. Disclaimer, nothing I say is advice today, guys. Going to give a little portfolio update, very little bit of a philosophical overview as to how I'm positioning myself. I will use the publicly available portfolio that anyone can access for free. Most of the others do have, I would say, maybe 75% resemblance to this particular portfolio. So you'll get a feel for my overall philosophy. And the portfolio, the Maverick Life portfolio, is only accessible to premium members of the ROI Club and Maverick Life. Link will be in the description. So without further ado, let's get into it. Hopefully, my sound is better. I think I forgot to plug in the audio last time, so people were commenting on that. And with my new fancy AI companion, I've got captions down the bottom. So if you don't understand my strange accent, then you can read along as we go. So, story of value investing, guys. Volatility is your friend. It's not a measure of risk. Um, so far, we're looking pretty much flat on the year until the last quarter. It's all starting to come to the fore. We're going to talk about why that is. Currently up 13.8% on the year with a few little mistakes on my behalf, which have been corrected. Got plenty of cash in the bank. So things are looking pretty good. So, philosophical overview. Let's take a look at how I've positioned the portfolio, what I want to have in my life right now, just because I like less stress as I get older. I'm looking to get somewhere between, say, 75% to 80%, 25%, 20% mix between the good old fashioned deep value on the talk side. So the things I've been talking about for several years now, if you go back to watch videos maybe of 2021, 2022, finding deep value, cyclical plays, cigar butt type investments, banking on a business turnaround and or accompanied by a market re-rating. So we get Peter Lynch's twin turbo factors, growing earnings, growing multiples, and then as you get older, you start to realize you then have to do more work. So if you're successful, that is, you have to rotate that capital. You have to do things like I did, which is seek out different residencies. You got to look at different tax strategies. You got to do all this stuff. Or you can take a leaf out of the genius that is Murray Stahl's book, and you can start to look at how you can structure these things to be tax efficient and minimal and minimal input, minimal active management in the sense that we are often our own worst enemies as investors. My first year in public investments was the same. I thought I'd just transition straight from private investing. I'd go straight in. It'd be all the same, no worries. Big, big lesson. So what you can see here is I've just got a breakdown, a very simple breakdown of where this particular portfolio lies. Other portfolios are a little bit different, but you'll get the hang of where I'm going. So we have here, let's say, the hard asset interests that are capital light businesses. So these businesses are high return on invested capital, very, very high free cash flow margins, very, very high free cash flow conversion rates. These are businesses where basically lots of the dollar of sale drops through to the end result. Okay, so net profit after tax. We're looking at 65 to 70% in some cases, even higher free cash flow margins take home. For every dollar of sale, these companies can take home 65 to 75% of that to the bank. That's what I'm looking for. These businesses have interest in hard assets. So in an inflationary environment, their top lines will do very, very well. But because of their superior operating models, they are capital light. They do not have to have commensurate increases in the expense column, which is why they have such good take-home margins. In addition to which, they also have no capital requirements really in terms of continuing their operations. This is huge. Why? Because when you get all that free cash, you do not have to reinvest it into the business. You can take it home. You can take it and go on adventures like I do, you can do stuff for you with it rather than continuing those operations. This is huge. This is huge. This is huge because it's allowing for compounding to take place over time, very capital efficient. And the last point on that is you have exploratory upside. So the operators that take place on the leases for a lot of the royalty companies, they're in charge of the expansion capex. You get a check in terms of the upside sales, the income. You don't get a check when the expenses are handed out. Okay. There's another saying, one of many from Uncle Rick. Today, we're going to look at the big ones, Texas Pacific and Landbridge, which I know you're all sick of me talking about, but I really don't care. Another thing I've been thinking a lot about is my best ideas are freaking good. The mistakes I'm making is just not buying enough of those and sitting back and relaxing. Okay. We're also going to talk about Valaris because it, as you'll see down here, is a very large portfolio weighting, still the biggest because it's a high conviction play in a high conviction sector. It's not a forever play though. Okay. So that's why it would be placed in the talk or the deep value bucket. So at the moment, about 50% is in the inflation beneficiaries, let's call it, the high quality businesses. You've got your inflation beneficiaries, but more deep value cyclical guys. They're down here. They represent about 30%. And then you've got your crypto. Okay. So that's roughly what you're looking at in terms of the eToro portfolio as this was calculated. Now, can get rid of that. I'm on fire today, guys. Other news that needs to be discussed just briefly. US dollar. So Trump wins the election. That's all wonderful. It doesn't really change the fiscal situation, and monetary policy is 100% going to follow suit. JPAL overnight, here in Australia at least, it was overnight, lowers Fed funds rate. We're looking at 4.5 to 4.75, so that hasn't been adjusted yet in the chart. US 10 years at 4.3. We've still got that inverted yield curve. And it looks like easing conditions are starting to come to the fore. The commodities market, I won't go through it now. I'm sure you've seen all over Twitter or where have you, are going nice and strongly. The DXY still continues to stay above 100. There's no reason why that would particularly drop because other other currencies are in pretty much the same situation, and it is what it is in terms of the DXY. I'm not that interested. I am kind of interested in the 10-year because that's the discount rate used for a lot of people, but I'm much more interested in the commodities prices, particularly the gold price. So that being said, we can move on. The portfolio, Valaris reports earnings, and before we go into the earnings, I will briefly touch on the initial thesis for Valaris. I've got my other laptop here. So if you remember, and you can go back and watch this, this is on YouTube. I go through quite extensively how I come to these conclusions. I start with the replacement value based on new build estimates using the IRRs that are required by investment banks. This gives you, I won't go over it, you can go watch it. This gives you an idea as to where day rates would need to be before these companies invested in new builds, invested in bringing on new supply to the vessel market. Okay. If you were asleep and wake me up until that comes, stay asleep. Okay. This is just a dream. We haven't hit day rates. We're nowhere near that yet. It's all heading in the right direction. Sit back and relax. We came up with sort of 615 mil for a semi sub then. Now, today, I'd say it's probably over 700, maybe three quarters of a bill. Who knows? And jackups 250 to 300. My mate Tommy Deepwater thinks maybe 2 to 220. And obviously, you come to your own conclusions. New drill ship, most of us agree that it's somewhere over a billion, 1.1, some say 1.2, what have you. So we take the fleet, we take those ideas, and we come up with a valuation. Okay. Now, this is not a replacement cost of the current fleet. To the accountants watching this, I know there's depreciation schedules. I know that. This is just a starting point for the thesis. That's all it is. $342 a share if you had to rebuild this thing from scratch today. Here was the backlog. This hasn't been updated, so you'd have to have a look at this. But the point was, this was always, as you can see, I've highlighted here, a 2025 story. So we all need to take a deep breath and stay calm. The price action in 2024 is not telling us anything at all about what's going on in the economics of the business. We're still trading at an even larger discount to replacement cost. Day rates are going up. The backlog will roll over mostly in around mid 2025, and that's where I'd expect things to start to get interesting. So no changes, no dramas there with that sort of thing. Okay. I came up with a reasonable, I thought, exit price of around $200 a share if you were to get to a free cash flow multiple that I think this thing can do. And if you look at a replacement cost, a brand new replacement cost, obviously, and that would be even higher than that. Nothing really changed. So Valaris reports, they reported to my notes, revenue is up, EBITDA is up, free cash flow is strong. Most of that free cash went to buybacks. They were good to their word. This is what they said they were going to do. They're buying back. By my calculations, using an average price of the last quarter or so, I think they've bought back 1 to 2% of the entire float, which is good. So those numbers might even be updated based on the now reduced share count. A little bit of noise around the jack-up market. I don't think anything really changes there. Revenue projected 2.6 billion for the next year, which would be 17% year-on-year growth. Earnings reduced down to around about $8. I had them doing a gap next year of about 10. Either way, I don't think it's a big issue with the stocks trading in the sort of low 50s. I don't think that's really worth much more of a remark. In terms of where this thing can go moving forwards, if you take what they've done since their whole restructuring in 2020 and then 2021, you use that year, the thing's growing at top line 20%. I mean, it's growing at a heavy clip. EBITDA's expected to grow by 26, 70% CAGR. I mean, this thing can really create some torque. Next year, I really do think they can get to 300 mil free cash, maybe a lot more than that. 600 by 2026 seems really quite reasonable to me. About 300 of that will be used as capex. So what do? They take 300 and buy back another 2%, 3% of the entire float. Pretty tax efficient way when your shares are trading at less than a 20% discount. So still bullish on Valaris, still holds the largest weight, just because I've been in there for a long time and took the opportunity to buy a little bit more on the downturn. And that's pretty much all I have to say about that. I think it is the simplest way forward from here. People ask me about RIG. I still own RIG in other accounts. I just wanted to buy more Valaris. So I sold out of some RIG, rotated that capital into Landbridge and Valaris, and I'm pretty happy. I'm pretty happy about it. So not too much to say there. I still think, updating the recent numbers here in my base case, you're getting to about 215 per share still. Very, very healthy IRRs in the 40s for my base case. So, in terms of weighting, let's talk about the next one, which is Texas Pacific. Invested 10% straight of the portfolio there. This is a company I tend to hold for probably as long as I live. And very, very fortunate in terms of being able to buy it with the timing that we have. And it's up already this year, 55%, since I really started to allocate to it. So not much to say there. Stock price at 13 and change. And as I've mentioned when I did the particular analysis on this company, it's very, very hard. It's very, very hard for me to impart what I imagine and look at both empirically and intuitively to you through the screen using pure old school cookie cutting valuation metrics. This thing, 800 odd thousand surface acres in the Permian, they never have to spend another cent on acquiring more acreage if they don't want to. They can sell some of that, buy back their stock if we get a downturn in the stock price. They have a multitude of ways to win, and the thing will be running for decades to come. That requires no capex, it requires no opex, really, and it has an upside to every inflationary environment that you can think of, while still outperforming during down markets. So I can put together a spreadsheet like this. It's conservative. This thing is conservative, and it only gives it a decade's worth of value. The thing with having businesses that don't require capital, that still have inflationary benefits, they compound and they last into the future because you got the pricing power without the expense column. This thing, I think it could be worth, I don't know, I've put in here on an EBITDA valuation 16, but by the time we get to the end of the decade, it could be worth double or multiples of that. Such is the optionality of the business. So that's that. I think the best way to look at this, and I've answered a few questions that I've got around it, is to stop thinking about this type of numbers just for a second, not completely, just for a second, and plug in what you think earnings could be, and then compound that over time with an ROIC of 42%. And that is conservatively what the company has been able to do in a fairly soft commodity decade, which was the last decade. So that's it. I don't know. I don't know what more to say without really boring and annoying you all, which I don't want to do. So I'm going to move on. I'm going to go into the big one. The only thing that worries me about this company is that I'm truly in love with it, and that's always a bad sign. But again, it is another one I intend to hold until I die, basically, unless something really changes. Of course, it's Landbridge. Okay, I've been speaking about it a lot. Um, it's just gone bonkers, absolutely bonkers. It's nearly up 100%. I'm cursing eToro because they couldn't let me buy it in this. It didn't come on the platform until it was, I think, in the 30s, somewhere around there. And I bought a fair bit. I luckily got in just after the IPO. So in my other accounts, I'm up even more. I'm very glad about that. What can I say? The company is delivering. It's doing exactly what it said it was going to do. It's like your chance to buy Texas Pacific at a fraction of the market cap. It doesn't have as many acreages. I know, but it's got other ways to win, particularly around the easement and water transfer. So, man, what can I say? I'm really happy with it at Landbridge. I tend to hold it well into, I don't know, when I'm 70, 80, 90, who knows, as long as I live ideally. This thing has reported, I haven't been able to go through the 10Q yet. They haven't filed it, but I've looked at the presentation. I thought I'd give you a little bit of a summary. So, Landbridge, revenue up 60% year over year. It's not a tech company, it's a land company. It's kind of a tech company because they've signed their first data center deal, I believe, in the reports. Um, and they're starting to pay a dividend. So I'm happy. Basically, everything that I can see in terms of the revenue breakdown. Again, I haven't seen the 10Q yet because it's not available. Appears to be those recurring revenue streams. It requires really no extra capex. Really, there are some nuances with this one versus Texas Pacific, but it expands its acreage and it's paying out a bit of a divvy. Not much more to say. I've updated the numbers here. I think I had it at around 90 in terms of EBITDA. I think it's going to do 100 in the blink of an eye, and it will continue to grow that at those rates. So I still think, and this is another thing that people have asked me about, yes, the stock price has gone up an incredible amount. There have been a couple of double-digit days on the day, the stock price increase. What's the value? You go away and you come up with your own estimates, either as a sum of the parts for the land value, look at the types of revenues and the fees, and then discount that at what you think is an appropriate rate, whack a multiple on it, and it'll put you at least in the ballpark. And then you go and say, is there still a massive difference between what I think this thing is worth from EBITDA? Free cash will be basically the same thanks to the operational model at a growth rate. And okay, yeah, we started the year at 18 at the bit over 17 at the IPO price, and now we're at 68. And you think, holy moly, this thing surely needs to take a break. That's not the right way to think about it, really. I'm sure it will pull back at some stage. 178 over the next decade is, in my opinion, almost a layup. I hate saying that, but it really all makes sense. So, there are my updated thoughts. There's a portfolio overview with my philosophy. And so I hope that you enjoy that. What I would love to be able to do is deploy some of the extra cash. I think there's going to be a bit of market euphoria. I've got a few starter tracer positions on, but these are the big ones. And they tell you basically that they sum up my philosophy in a nutshell. So you've got a very deep cyclical value play, discount to asset value and a discount to cash flow in Valaris. You've got superior business models, TPL, Landbridge, Wheaton Precious Metals as well. Gold Royalty Corp, I'm super bullish on this thing. I'm writing a ridiculous amount of put options, and I'll either keep the premium or I'll get more stake in what I think may be the next Franco Nevada. Thank you to everyone who's subscribing. Thank you everyone who's following. I will have a 1,000 subscriber special edition update coming over the weekend, and I greatly appreciate your following me. Any questions, leave them in the comment section. Otherwise, I'm going to head off and I'll come back with another overview, perhaps of the middle tier holdings, and we'll see where we're at. Take care, guys. All the best, and I'll see you in another video.